We are streaming live now on Facebook, and I want to say good morning to each and every one of you. It's a delight to have you here. Our Coffee with Corn, this is the summer edition. This is meeting number 3. We've had some really good speakers, our first 2, and I'm delighted to see that Kristine Tigran is joining us this morning. She is the director of the Center for Agricultural Law and Taxation at Iowa State University. Her topic obviously is hitting home with a lot not only of farmers, but also a lot of businesses and individuals that are looking at handing their possessions down to the future generations. So without further ado, I do want to introduce to you and turn it over to Kristine Tigran, Director of the Center of Agricultural Law and Taxation at Iowa State University. Kristine, take it away.
Thanks, Terry. It's great to be here with you all this morning. And I have a lot to cover, but I like to make this presentation one that's interactive. We have a small enough group here that you can type in your questions and we can hopefully address everything that you'd like to talk about today. So what I'm talking about are all proposed tax changes, and I want to say that from the onset that these aren't things that have happened already. These are issues that our legislators and Congress are looking at right now. So I want to just make that clear at the beginning. I have put my contact information here in my slides, and I think the group can make these slides available to you as well. They'll just have to let me know how to get them out to you in a way that you can see them later if you'd like, but those are available to you. We have a website that we keep at our center that also is designed to help keep people up to date on what's going on. So without further ado, we don't have lots of time this morning, so I want to make sure we can cover as much as possible. And I want to give you a little bit of background on where we're at in terms of legislation with the new administration and the Congress as it currently stands. So in March, many of you remember that we had a very large COVID relief package that did actually pass. It was $1 trillion. It was called the American Rescue Plan. Lots of provisions in there for families with children, for healthcare expansion, for the employee retention credit for businesses, etc. It's a very tight passage of that bill, but it laid the groundwork really for what we're going to talk about this morning in terms of the American Families Plan. A lot of the provisions within this American Rescue Plan that was passed into law in March, Congress is wishing to make them more permanent. So some of you with young children, you may have been getting now a deposit in your bank account starting in July of this year, which was an advanced child tax credit. Many in Congress on the Democratic side want to make those provisions permanent. To do that, of course, it's going to cost a lot of money. There's also the American Jobs Plan, which is the infrastructure package that you've been hearing about as well. Now that one's a little bit further along in its development. We'll talk just briefly about that as well. But most of what I'm going to talk about with you this morning is what is proposed in the President's American Families Plan. And the reason why I'm going to spend so much time on this, even though it doesn't even have legislative language yet, is because it really would transform the way that taxes work at the time that you die. At the time you give away property. It would really change the way that we handle transition planning for farms and businesses as well. And so we first saw this plan announced by the president in April 28. He unveiled it in a speech to the country. And the way that the plan is advertised is that it's intended to grow the middle class, expand the benefits of economic growth to all Americans, help America be more competitive. And it says that it will only increase the tax on the wealthiest Americans. Then about a month later, we got what's called the Green Book, which is the Treasury's detailed information about what the president was proposing. And so I guess what we'll look at in a minute is what the benefits are that they're proposing. And then we'll spend most of our time this morning talking about the pay-fors, how they would pay for it, what that would mean for our taxes. So that's where we're headed. But I do want to give you an update logistically in terms of where we're at right now, because if you're following the news from Washington, it's kind of hard to keep up on what actually is going on. So there has been a push over the last couple of months to come up with a bipartisan deal on what they're calling the infrastructure plan. Now, this is the roads, the bridges, the broadband, and a lot of other things in there. And at this point, it's about a $1 trillion package. We got some legislative language, 2,000 pages long, right? This just came out. And they're actually hoping to pass this infrastructure bill through the Senate this week. Then the Senate Democrats, and there's a little bit of bipartisan support for the physical infrastructure bill. So for that reason, they are going to be able to likely get 60 votes to get that through. But then the other package, the one we're going to spend most of our time on, is what some are calling the human infrastructure bill. And this one is huge, $3.5 trillion cost is what it would involve. And if you're hearing about a budget resolution, I just want to give you a little procedural update on what all that is. So the Senate is also wanting to be able to pass a $3.5 trillion budget resolution this week as well. That's not the bill. That is just the opening budget to say, okay, committee 1, committee 2, committee 3, committee 4, go off and write the language of the bill. We're going to go away on recess. September 13, we're going to come back. We'll have a legislative package. And at that point, the Democrats would like to vote on that package. And it would be through budget reconciliation, which means that they would only have to get 50 votes and they could get it through. Now, what we hear a lot about this budget reconciliation, but what is it, right? Normally in the Senate, you have to have 60 votes to avoid a filibuster. But there is a procedure that you can follow called budget reconciliation, which allows Congress or the Senate to only have a simple majority vote if it has something to do with spending, revenues, and the federal debt limit. Now, it gets really complicated how they fit all this in, but we've gotten to the point where we've passed a lot of bills, a lot of laws that we have now were put into effect through this budget reconciliation process. So if you think back to the Affordable Care Act, that was passed this way. You think about the Tax Cuts and Jobs Act in 2017, that was passed this way. And then the American Rescue Plan Act that I was telling you about from March, that was passed this way too. So those are 3 very large packages. Of course, the Affordable Care Act, the American Rescue Plan were Democratic packages, but the Tax Cuts and Jobs Act was a Republican package. So both parties have used this, and that's likely where we're going to be in terms of this American Families Plan, how it would actually get to the Senate floor, how it would actually get before the House eventually, and perhaps pass into law. But there's a lot of hurdles along the way. A lot of folks aren't quite sold on this. So that's what I want to dive in today and explain what is involved in this American Families Plan. So this is the human infrastructure, right? The roads, the bridges, the things that they're talking about in the other infrastructure package that they're voting on this week. That's separate and apart from this second plan that would be part of this larger $3.5 trillion human infrastructure plan. And so let me just explain to you why they want to pass it, what's in it, and then we're going to talk about the impacts on those who have property in particular that has appreciated in value. So the plan would propose $1.8 trillion in benefits, mainly to families with young children, $1 trillion in investments, $800 billion in tax cuts. They have lots of explanations about how the program will be paid for. And then the language in the proposal is that, well, nobody earning more than $400,000 will have to pay any more taxes than they pay right now. So that's the language that's there. And what they're wanting to pay for is universal preschool for 3- and 4-year-olds, 2 years of community college that's free, increased Pell Grants, scholarship programs for future teachers, lots of family support, making sure that there's money for healthcare, $15 minimum wage for child caregivers. I'm just giving you some of the highlights of what they're advertising in terms of what they would offer. Expanded nutrition assistance. The president didn't propose this initially, but it looks like there would also be an inclusion of an expansion of Medicare to include dental, health, hearing, vision coverage within Medicare. And then the big one would be to expand a lot of refundable tax credits, like that child tax credit that has been expanded this year temporarily to $3,000 per child if they're over 6, or $3,600 for young children, and then paying those credits out to families on a monthly basis as they started to do this July. That is something they would like to make permanent. Expanding the dependent child care credit, expansion of the earned income credit, lots and lots of things, increased credits for the Affordable Care Act. So that's the Obamacare healthcare marketplace, and making that more able to be accessed by more people. So those are all of the human infrastructure proposals that are in this plan. And so the big question is, how would it be paid for? And so let's dig in, and I'm going to give you the highlights. And as I said, I'd like to answer and address questions that you have along the way, or at the end as well, whatever's more comfortable for you. But the first proposal is pretty straightforward, is just to increase the top individual tax rate. So starting next year, what they would propose is to go back to the top tax rate that we had before the Tax Cuts and Jobs Act. So before 2018, the top individual tax rate was 39.6%. And then the Tax Cuts and Jobs Act lowered that to 37%. And you know, there's a little bit of adjustment as well in terms of the break point, the income threshold at which that highest tax rate is reached would also be lowered, which means that people would pay more tax at the high end. But so far, right, that's still just hitting those people that earn definitely more than $400,000 per year. So that seems in line with what the president's proposal is. So increase the top tax rate. Then we move into more uncomfortable territory for a lot of farmers and landowners who own appreciated property. The proposal says, and notice the date here, beginning April 28, 2021. This is proposed to be retroactive. And again, we have nothing but the proposal. We don't have legislative language. All of this could change. But they're proposing to eliminate our preferential capital gain rate for those who have more than $1 million in income. So we're not just talking regular ordinary income, we're talking capital gain. So those of you with appreciated property understand that if you have land, for example, that you bought at a low price, and then you go to sell that land many years later at a higher price, any appreciation in value is capital gain that is taxed. And under current law, it's taxed at a preferential rate. The highest rate for an active farmer to have to pay if they sell land in their trade or business is 20%. And this proposal would say if you have income above $1 million, including any of your capital gain, any of that income, any of that gain over $1 million is going to be subject to ordinary income tax rates. Now, what are those ordinary income tax rates? Well, those would be back to that top rate of 39.6%. So essentially, for any gain over $1 million, the rate would be nearly doubled from 20% to ultimately 39.6%. This is this year's ordinary income rates versus long-term capital gain rates. But remember, I said that they also want to raise the top rate from 37% to 39.6%. So at the highest rate, capital gain would be taxed at a double rate. So the gain over $1 million would be taxed at 39.6 if it were above $1 million. And then there would be this other tax that non-farmers already have to pay, people who are not in a trade or business already have to pay, and that is that 3.8% Medicare tax. So many of you have heard of this. It's the extra tax that went into effect with the Affordable Care Act. It was intended to help fund the Affordable Care Act. So it's called the net investment income tax. It's also called the Medicare tax, but it's a 3.8% tax that currently impacts net investment income. If you're married, you only have to pay it on your income above $250,000. But what this plan says is, well, we want to expand this 3.8% tax. And we don't think it's right that someone who sells a property that's appreciated, even if it's not in a trade or business, essentially we want all investment income, all income to be subject to the 3.8% Medicare tax if it's above $400,000. So we have to kind of keep track of all these little breakpoints. But if you're following me, this means that if you sold appreciated property at a gain, it would be subject to the maximum 20% rate below $1 million. But then above $400,000, it would also get this 3.8% rate put on top of it. And then above $1 million, it would be taxed at 39.6% rate. So lots of increases in tax there. It also appears that our self-rental income, if I own my land and I rent it to my farm business, different entities, that would also be subject to the 3.8% tax, which currently we don't have to pay that on our trade or business rental income. But otherwise, if you're just cash renting your ground, currently you're already subject to that 3.8% Medicare tax. So that's the provisions that would just raise the tax rates, make it more expensive to sell appreciated property. What really has been a significant part of this proposal, however, is the proposal to have a new tax at death or gift implemented. So what the proposal says is, beginning in 2022, that's coming up quickly, it would treat the transfer of appreciated property at death, or if you give it away, the same, as a sale. Meaning that if you have any unrealized capital gain, right, any appreciation that you didn't pay the tax on, under current law, we get a step up in basis. Nobody ever has to pay that tax. This law would say, oh, you have to pay the tax at the time you die. And so dying with appreciated property would trigger taxable income. And it's a new tax. It's not a estate tax. It's not a gift tax. It's an income tax, but it's an income tax on that gain that accumulated during your lifetime. And notice that this gain would be taxed at these new higher rates as well. So it can get a little bit expensive. And we're going to go through some examples because it's kind of hard to kind of follow all this. But there is a good part. The good part is that the provision or the proposal would allow every deceased person to have a $1 million exclusion. So for your gain that you have, you would get to not pay any tax at your death on $1 million. And I'm going to talk about death mostly. I'm going to say death, even though this applies if you give it away during your lifetime as well. But they're proposing that you could die with $1 million of gain and not owe any new tax, but any gain over $1 million then would be taxed. And then if you're married, each spouse would also get $1 million exemption, and that could be shared between the two. So essentially, married people would have a $2 million exemption for all of their property that they own together. And then under current law, many of you likely know that if you own a personal residence, if you have a house, and then you go to sell that house, and you've had gain that has accrued in that house since you purchased it, since you built it, that you don't have to pay the tax on that up to $500,000 if you're married. Well, they would apply that same provision to death as well. So most of our farmers, we don't have gain over $500,000 in our house. We're more worried about our farmland, our farm buildings, et cetera. But if you hear $2.5 million in gain that would be excluded from death, from taxation at death, that applies to a married couple, and that $500,000 only applies to the residents. You can't borrow that and apply that to your land as well. So if the property is transferred at death, what does that mean for the basis, right? So under current law, the only good thing about death is that any increase in value of the property over your lifetime, all of that gain is just sort of wiped off under current law, and our basis adjusts to the fair market value at our death, right? And so under this provision, we would still have that effect. We would still have a step up in basis. We just wouldn't have a tax-free step up in basis. The first $1 million would be tax-free, but after that, we'd have to pay the tax, and then we would get the step up in basis. So here's an example. If I transfer a $5 million parcel of land with $3 million in appreciation at my death, so I have a $2 million basis, it's appreciated $3 million over my lifetime, my heir, my descendant, is going to receive the land with a $5 million basis. That's going to be a step up to fair market value, but they're going to have to pay the tax on the $2 million of gain, and $1 million of that will be exempt under that $1 million exemption. So that's how that would work. Now, if I give it away, they're not quite so generous. I would still have to pay the tax, so I would still have to pay the $2 million for the gain after I take away the $1 million exclusion, but my recipient of the gift would only have a $4 million basis in this $5 million property, because they're not going to give you that $1 million exclusion as basis. So under this proposal, they're being a little stingy with the basis on a gift. So it really would discourage lifetime gifts, probably even in a more significant way than currently, because under current law, as you know, we don't get the step up in basis either. But at least under current law, if we give property away, we don't have a tax bill, right? This would give us a tax bill, and it would rob us of basis. Now, a couple of things before we dive into some detailed examples to kind of show how this works, because I realize it's a lot. It's pretty complicated. Again, this is not an estate tax. The current estate tax would still apply. So what's the difference? Well, the estate tax, as you know, is the value of everything you own. So it's the actual value of your assets. Now we have things like special use valuation that can come into play to reduce the overall valuation, but the estate tax has really not been a huge deal for many farmers for quite a while because the exemption amounts have been so high. So under current law in 2021, I have an $11.7 million exclusion amount. That means I can die with $11.7 million of assets and I won't owe any estate tax. And if I'm married, I get a double that. So $23.4 million my spouse and I can own and not owe any estate tax. So under current law, we don't have lots of farms that are subject to the estate tax, but that would still be in place. That would still be here. This would be a brand new tax in addition to any estate tax that would be taxing the gain, taxing appreciated property. This is a new system. Nothing like this has ever been implemented in our country before. We've had estate tax. We've had step up in basis since back to 1921. Never in the whole history of our country have we had a system where when you die, you pay tax on unrealized capital gain. We have almost always had a step up in basis. Back in the 70s, Congress passed a law to have a carryover basis for a short time, but then that was kind of unwieldy. So they went backwards and they undid that law retroactively. So we've always had the step up in basis. We've not had to pay gain. But, you know, Congress is looking for ways to raise money and they look at all of that appreciation. And if you look at it in a different context, for example, Microsoft stock, right? And let's say I have millions of dollars of Microsoft stock that has appreciated, you know, millions of dollars over my lifetime. Current law steps up the basis, wipes that out as well. So, you know, this, I think a lot of times when Congress is thinking about this proposal, they're thinking about wealthy investors. In fact, that's the language they use quite frequently. But farmers, rural landowners have lots of appreciation in the assets that they use in their business, in their farming business, in their farm rental business. And so it would definitely be an impactful provision in the rural sector as well. Terry, I see you pop up. Is there a question you wanted to raise?
Yeah, before we get too far in, the question is, are like-kind exchanges provisions remaining the same?
Yeah, we're going to get there as
proposed to them.
Yeah, so that's a great question, and we're going to get there. There's definitely a proposal to scale back the like-kind exchange as well. So again, it's going to all be in the details of this. But great question, and we are getting there. So yeah, if you're thinking about, okay, how could I get around this? Like-kind exchanges are one of our favorite tools, right? For consolidating our land. I might find a piece of ground that's closer to my regular operation. So I'm going to save, you know, all the logistics of driving so far with all my equipment. So the current 1031 gives me the great tax-free tool to say, okay, I'm going to trade this property far away from my property closer to my other operation. It's a great deal. And they want to scale that back as well. So hold on to that. We're getting there. What about if land is in a trust or appreciated property is in an LLC or a corporation or partnership? Well, the proposals that are on the table right now are applying to individuals. Corporations are treated differently already. We always say, you know, it's not good to hold land, for example, in a corporation because the tax consequences are kind of tough. You know, and now it's might be kind of tough to hold land as a private person as well, as an individual. But what it says is, what the proposal says is kind of an unusual provision, and I'm not sure how this would work out. It says, well, gain on appreciation that hasn't been realized would be recognized by a trust, a partnership, or a non-corporate entity like an LLC if that property has not been the subject of a recognition event within the prior 90 years. So essentially, it's identifying that, okay, if you don't do something with trusts or partnerships, everybody will just dump all the property there and the gain will never be recognized. So the proposal, and this would definitely likely be subject to change how this would work out, would implement a recognition event in those entities every 90 years. So they're not ignored, they're not left out. But it's kind of interesting to see how that would work. And the proposal says that that first recognition event would occur the end of 2030. So we're not going to get any more detailed into that because it's a little bit unclear how that would actually work. Also, if you're wondering about all of that farm equipment, machinery, and all of that, we all know how it works. We buy it, we use Section 179, we use bonus depreciation. Much of our machinery is depreciated or expensed to basis being 0 or very low. We die and our heirs get a step up in the basis of that as well. Now, we don't know how this proposal would treat that equipment. The proposal just says, oh, it would exclude from recognition any tangible personal property such as household furnishings and personal effects. But, you know, technically equipment is tangible personal property, but it doesn't address exactly how that would be treated. So we just don't know. There's a lot of question out here about how this would play out. Again, we will definitely need to see any legislative language that is proposed, but we likely won't see that until September. And if history is our guide, we may not see some of these proposals, the actual legislative language, until a couple days before they actually take a vote, right? We've seen how that works, and many hundreds of pages of legislation has been often passed over the last several years without people really even having a chance to read it terribly closely. Now, here's a really key provision that would factor into all of this, because no matter who the person in Congress is, it seems like most all of them acknowledge that this could be a problem for family-owned and operated businesses, right? So they talk about the family farm, they talk about the family business, and they say, oh, well, we're gonna take care of that. We're not gonna make them have to worry about this. But the question is, what would a family business, and a lot of people like to say exemption, what would a family farm exemption from this tax look like? Well, the answer is we don't know. It could, you know, that how it's defined would make all of the difference, because it sounds like from the proposal itself, here's all we're told: the payment of tax on the depreciation of certain family-owned and operated businesses would not be due until the interest in the business is sold or the business ceases to be family-owned and operated. So I read that to say, doesn't mean that the tax won't be assessed, doesn't mean that the tax won't be calculated. It just says, oh, you have a deferral on when that tax would be due, and it wouldn't be due as long as the farm continued to be family operated and owned. Now, that also leads to a bunch of questions. How would they define family? Would it just be your kids? Would it include your cousins? Would it include your nephews, your nieces? Don't know. To qualify for this deferral, does the owner of the property have to be a full-time farmer at the time they die? Or could they be a retired farmer? So much of our land in rural America is rented out by owners who used to farm. They don't farm right now because they're scaling back. But under most tax provisions out there, if you're cash renting your ground, for example, you're not considered a farmer. So would any sort of family business deferral would likely not apply to those situations. So again, the definition of family farm and any sort of deferral would be really important. It would be also really important to understand how this would work, because if you're going to have a tax that's actually calculated and essentially assessed, it would seem like it looks like from the proposal, it would essentially be a lien on your property over the lifetime of the business. So the business would be operating, but how would lenders look at you if you have this large tax lien hanging over at any time if you fail to meet the definition of family owned and operated, that the tax becomes due. So again, there's talk about, oh, farmers would not have to pay any tax, but we have to really see what details would be proposed. And it's concerning to think about how this provision could possibly impact farmers, family-owned lands, etc. So we just don't know. There's also a provision that would allow a 15-year fixed rate payment plan for the tax if you didn't have a deferral. So if you had to pay the tax and you have an illiquid asset like farmland, you would have 15 years to pay the tax. So, and there's a little provision down here that says IRS could require security at any time to continue that deferral if you are a family-owned farm. So again, it appears to defer the tax liability, but it's just not clear exactly how that would all work. The basis would step up by $1 million. But the remainder would seem to have a carryover basis until such time as any tax were paid. So again, that's a real big provision that we're watching if they come out with legislative language to see what that would look like. Because how farming is defined, whether you'd have to have a crop share lease, whether custom farming would work, if you're retired, if you're widowed, the special use valuation rules that we've had for many years, those are pretty narrow. So if they applied similar rules, this exemption would not be terribly broad. So let's look at a couple of examples, because that's really how we can kind of explain how this proposal would change things from the way the current law works. I'm using round numbers. I'm using kind of high numbers just because it shows very clearly how this tax change would be implemented. So I just pick a couple. Harris and Harriet, let's say they have 1,000 acres of farmland. And let's say that they've been in this business for a very long time. So the basis in their farmland is very low. So let's say they bought some of it at $550 an acre. They bought some of it at $800 an acre. And so now, under current law, as you all know, this is current law. I'm not talking about the proposal. If they would sell that farmland for $7,200 an acre, which is pretty much fair market value in a lot of counties here in Iowa, they would have taxable long-term capital gain of $6,500 per acre, or overall $6.5 million. that's just the way farmland works, right? We have a lot of gain in it in a lot of cases if you've held it very long. And so at current rates, under the current law, if they were to just sell all their farmland and liquidate, move to Tahiti or something, right? We know that a lot of them would choose not to, because if they would sell, they would be subject to $1.2 million in tax, which under current law would be about 17.6% of the sales price. And let's say that they currently farm, so they don't have that 3.8% tax that they have to worry about. And if they had been cash renting, then they would also have to add in that 3.8% tax, which would also increase the current capital gain. So they would owe $1.5 million of tax under current law. So under current law, it's still not a picnic, right, to sell appreciated land during your lifetime, because it can get very expensive. But let's say that they die, right? So let's say that they die together, just to make things simpler, and that they leave their property to their daughter, Jordan. And when she inherits the property, as you all know, under current law, her basis is adjusted to the fair market value of the assets on the date of death. And so suddenly, of course, Jordan inherits all the property at $7,200 an acre is the basis, no taxes due. The estate is less than the $11.7 million per person exclusion. So there's no income tax, there's no estate tax due at Harris and Harriet's death if they die in 2021. That's current law, right? And then the last little review about current law, just so we're all on the same page, if they decided instead to give their property to Jordan while they were alive, right? Tax advisors would say, oh, you probably shouldn't do that. Why? Well, because if you give it away, you have that carryover basis. And so Jordan would inherit the land. She wouldn't owe any tax, but she would have a very low basis in the property, right? It would be $550 an acre, $500 an acre. She'd have that low basis so that if she had to sell the property, she would be subject to all of that gain that Harris and Harriet would be if they sold their property during their lifetime. Now let's roll forward and let's say that the American Families Plan is implemented, and let's see how that changes things. Well, let's just look at the lifetime sale itself. So we have we ran the numbers and we said, okay, if Harris and Harriet sold the property during their lifetime and were farmers, under current law, they would owe $1.2 million in tax, 17.6% of the sales price. Under this example, if you run the numbers under the increased tax rates proposed by the American Families Plan, even if they just sell their land, they would owe a significantly higher tax bill, $2.5 million. In this case, it would be 36% of the sales price. And that's on the high end as far as what most people wouldn't have that kind of tax bill. But then again, there are just pockets of places where the basis is very low and there's a lot of gain. And it doesn't mean Harris and Harriet were wealthy investors during their lifetime. They were just farmers that had farmland that appreciated in value. And of course, the reason why it's higher is because any of the gain that's over $1 million is taxed at the 39.6% rate. And Harris and Harriet, even though they're farmers, would also have to pay that 3.8% Medicare tax suddenly on the gain above $400,000. So that's why that tax jumps so much. Now let's pretend that it's just Harris, just to make it easier. And let's say that Harris dies. So what happens that's different? Well, current law, right? No tax, no estate tax, no income tax, and Jordan inherits the property at a stepped up basis. Under the American Families Plan, all of that changes. So let's say that Jordan's not actively farming, so we're not going to think about an exemption. And so Harris would have a $1 million exemption. So you would get to shave $1 million off of that $6.5 million gain that he would recognize at his death. But it means that $5.5 million of that gain would be subject to those new taxes. And the top rate would be 39.6%, not 20% like we have for capital gain currently. And so at his death, you would have an income tax bill, even though he's deceased, of approximately $2.19 million. That would have to be paid. You know, either Jordan could come up with the money or come from a sale maybe of a portion of the property, but because the tax is paid and the law would give a step up for the $1 million exemption, Jordan would have a step up in basis. She just wouldn't have a tax-free step up in basis. So she would own the land with a $7.2 million basis, but somebody would have to pay the $2.19 million in tax. And the proposal says that perhaps she would have 15 years to pay the tax. So it's just, again, watching the details. Now, if Jordan was farming, then maybe she would be allowed, if Harris was a farmer and Jordan was a farmer and she was taking over the family farming business, then maybe that deferral provision would step in. And even though there would be that $5 million of gain that would be realized, maybe the tax would not be due and it would be deferred. Maybe there would be a lien on the property. We don't know. But one more thing that we would have to think about. And notice too, we're going to have to think about finding at somebody's death. We're going to have to think about finding all those basis records. What was the basis of the property, right? And then we're going to have to get the appraisal of fair market value currently and calculate the difference to calculate the gain so that we can see how much tax we owe. So, you know, reconstructing basis records is something that we haven't had to do at death. We do it at gift, but at death, that's part of the beauty of the step up is we've been able to wipe that slate clean. Now, let's just say that Harris decides, okay, well, I'm going to give it away. Well, if you give it away during lifetime, you don't escape the tax either. So now, even if Harris just transfers the gift to Jordan, transfers the land to Jordan, they'd have to come up with that tax, that money to pay the tax, because there would be a tax bill of $2.19 million in this particular example. So giving away property that has more than $1 million of gain would also trigger tax liability. And as we mentioned before, the basis would step up to only $6.2 million, even though the land is valued at $7.2 million, because the $1 million exemption from tax would not give you a corresponding step up in basis. So again, we'll just have to watch and see how that all plays out. Somebody asked about the like-kind exchange. So what the proposal says is it would limit the real property like-kind exchange to $500,000 in gain per year. So if you're married, you could defer $1 million in gain. If you're not married, you could defer $500,000 in gain per year with a like-kind exchange. Kind of real severe restriction. It would work for small little parcels that you could shuffle around. But it would severely limit the application of the like-kind exchange. So we've already been kind of reeling in the farming world from the loss of the like-kind exchange for our machinery, for our trade-ins. It's caused a lot of, I think, distress and difficulty in tax returns, and bankers have had to get used to what a Schedule F looks like when it's driven down so far by the corresponding depreciation or expensing that's required, because all of a sudden you're having to recognize all of the gain on the property that you trade in. Now this would transform things as well in the ag sector in terms of taking away one of those tools that we rely on. And of course, here's how the current 1031 exchange works, right? So Martin farms in Western Michigan. He wants to move to Eastern Michigan to be closer to the farm, to the family. His 500-acre farm was a lifetime gift from his grandfather. And that should trigger something right there. If it was a lifetime gift from grandfather, it's probably one of those properties that has a very low basis because it wasn't stepped up at the time of the gift. And so it has a basis of $600 an acre. And now let's use that magic $7,500 an acre is the worth of that farm. And he's found a farm in Eastern Michigan of equal value. Current law, it's beautiful. You can use Section 1031 exchange, sell your farm in Western Michigan, reinvest the proceeds in Eastern Michigan. The law says, you know, you haven't changed your economic position at all. So we're not going to require you to recognize any gain. You will just roll the basis from the property you're trading into the property you're trading for, and things will be good. So that's how current law works. If the new plan went into effect, then suddenly Martin could only defer $500,000 of gain. His total gain is $3.45 million. So he would be required to realize $2.9 million in gain upon this exchange. And again, we look at the rates that it would be subject to. A big chunk would be subject to ordinary income rates over $1 million. And that's 39.6% tax plus the Medicare tax of 3.8% tax over $400,000. And so we got a pretty hefty a pretty hefty tax bill here of $1 million on this $3.7 million exchange. So again, in a situation like that, 1031 really wouldn't help very much. So again, what about that estate tax we mentioned? Well, the president is not proposing to change the estate tax in the American Families Plan. And I think the reason is because right now, yeah, we do have that $11.7 million exemption, but in 2026, the law is already scheduled to drop that exemption by half. So if you remember, before the Tax Cuts and Jobs Act, and here is a history of our estate tax exemption. So, you know, you remember the days when it was $1 million or 600,000 before the amounts that are here on the chart. But it was $5 million for a number of years. And then in the Tax Cuts and Jobs Act, Congress doubled it. And so it's effectively a $10 million exemption, but inflation is what pushes it up. So that's why we have the higher rate. When we say 11.7, it's really $10 million indexed for inflation. But the law, the Tax Cuts and Jobs Act, only did this through 2025. So all of these important changes in the Tax Cuts and Jobs Act, except for the lowering of the corporate tax rate, were temporary, right? 2026, they're all set to reset to where they were before. And so I think that those in Congress that want to pass the American Families Plan are thinking, well, let's not mess with this because it's already going to go back down to $5 million indexed for inflation. So we don't have to worry about that. So under current rates, we don't have hardly any farms that are subject to the estate tax. But again, this new tax, this new recognition of gain at death would subject a lot more farmers, a lot more landowners to a tax at death. There's also some legislative proposals. Of course, Senator Sanders proposed a bill called the 99.5% Act, seeking to lower that exemption down to $3.5 million at death and increase the tax significantly. Right now we have a 40% estate tax if you actually have to have your property taxed at death. But again, this is not on the table to vote on in September. We don't have any legislative language yet, but there doesn't look to be an appetite to really change the estate and gift tax. We're talking about the brand new income tax that's recognizing gain. So what do we do with all this? Well, it's really too early to make any changes or to try to figure out what I should do with my property, because we don't know what's going to happen. It is not clear whether these proposals will pass. They have to get every single Democrat to vote yes. And it's kind of going to be a tough sell because this does impact family businesses. It does impact family farms. And they can say that there's going to be a deferral, but it's going to be a tough provision to cover everybody that likely needs protection. So we're just watching for the details. But I would advise that everybody out there is watching closely, watch what's happening. If you don't like proposals that are on the table, let your legislators know. Try to stay up to date, work closely with your tax advisors, talk to them about perhaps things that you could do to protect yourself. And if it looks like the proposals are getting traction in September, figure out if there's any action steps that need to be taken. But again, at this point, there really aren't, but the end of the year could get interesting. We're really kind of following that and watching. And I just had a little information about the infrastructure bill, but I'd rather answer questions that you have about all the things that we talked about. So Terry, what's in the question box?
First question is, any change on tax treatment of land contracts? For example, sellers spread gain over a number of years to keep the yearly gain below $1 million.
Yeah, and that would be a situation where you would be able to fit into some of those deferral provisions if you plan really carefully. But again, this is, I die, I'm gonna have to recognize any unrealized gain. But yeah, if you've already spread it out and your heirs are taking over the contract, then that might be one of the ways that you can get around this.
Life insurance proceeds, will there remain no tax on them?
There is no provision in the plan that would suddenly tax life insurance proceeds. So, we have to watch, but so far, those are not part of this proposal.
Two questions and basically the same question. The presentation that you just gave, can we download your slides, and will it be available to view later? Because the one person would like to show his parents.
So Terry, that's really going to be a question for you all. I will make it available to anybody that wants it. And I don't know if you all have a way to put it out there. Otherwise, someone could email me, but I can email you my slides. And if you make it available to your people, you're sure welcome to share them.
Yeah, we will have that posted. We'll have a video and the slides posted on our website later this week, and I'll send an email out to the folks that were on this call.
Excellent.
Do we have any questions from the Facebook viewers at all, Angel?
We do not.
Good. Okay. Well, Kristine, you did an excellent job explaining that mess.
There's a lot of complicated details, and I just rest assured I didn't even get into half of them. So it's going to be an interesting fall, and it was just really great to have you online today. So thanks for including me.
Well, we have up on the screen right now for our people that are watching a closing poll that we'd like to have you fill out, because we really would like to have your comments. Kristine has done an excellent job putting what makes a lot of us break out in hives when you talk numbers and taxes to just explain. But again, I think the best part of the presentation was right here at the very end when you said they've got a lot of talking to do yet.
Mm-hmm. Yep, so nobody should get too worried yet. It's not a done deal, and we just got a lot to watch.
Kristine, we had someone ask if you could put your contact info up again.
Sure.
Maybe you could just go back to that slide.
Yeah, let me go back there and leave that up as we close out today.
Well, we still have folks on the line. I did want to mention that our Between the Rows tour is back on for this year. I know last year we had to do a virtual format, but this year we are planning to do 8 in-person meetings at farms across the state. They run from August 23rd through September 2nd, and you can register for those on our website. The whole staff's been out checking yields, so we're looking forward to sharing that information with you.
Great. Thank you, Angel. And Kristine, again, if someone does want to get in contact with you, they can email you, reach you there. I'm sure a lot of folks will have questions as we go through the fall season. And a lot of people like to put things in order before the end of the year. So I'm sure that everybody is going to be keeping up. You mentioned about getting in contact with your legislators, your individuals that could possibly be working on this. Are there any key individuals that you can think of right off the top of your head that might be really important to maintain contact with?
Well, I think that it's your senators in Washington and your House members as well. So you know, your key people in Congress out there, I think, are the ones that you need to reach out to in your district.
Kristine, again, thank you very much for being a part of our day. We really appreciate your information. Don't be a stranger, okay?
Thank you. It was really great.
Information for us. You take care. Have a great day. On behalf of all of us with the Michigan corn growers, we thank Kristine for all of the information. I'm Terry Henney with WSGW Radio. Make it a great day.